Good morning from London. I'm Guy Johnson. I'm alongside Kriti Gupta. We're an hour away from the opening trade. So what do you need to know this Monday morning? In Germany, the SPD beats the AfD in Brandenburg, but only just. We're going to be live in Berlin with the latest. In France, Prime Minister Michel Barnier's new cabinet will be sworn in this morning. His government, though, is already facing the threat of a no-confidence vote. We're going to be live in Paris on that one as well. And in the UK, the Chancellor, Rachel Reeves, will put a positive spin on Britain's economic outlook and signal that there will be no austerity. We'll be live in Liverpool at the Labour Party conference. Kriti.
Yeah, guys, we'll get a quick check on these markets here. Positivity in the equity markets, it seems, but marginally. You are seeing outperformance in the Eurostoxx 50 futures higher by 0.3%. FTSE 100 higher by 0.1% in the futures action. The currency story is where it's at. The euro dollar at 111, cable at 133. The countdown to the opening trade starts right now.
Monday the 23rd, good morning. Welcome to the programme. Kriti's back to civilization on our side of the Atlantic. It's great to see her. We've got a week of politics, a weekend of politics that we need to talk about. France, Germany, the UK, absolutely front and centre this morning. Plus, we're going to throw in some PMIs, which are going to give us an idea of how the European economy is performing. Welcome back to Europe.
Thank you. You know, I feel like last week I had so much FOMO that all the news was happening last week, and then this weekend really made up for it, especially in Europe. And I think a lot of the action in Germany, where we're talking about these these regional elections yet again, this one's a fascinating one because there are two ways to look at this, and that Olaf Scholz is narrowly kind of getting this victory, perhaps this big sigh of relief over in the SPD right now. On the other hand, is it really a sigh of relief for the SPD, or is it simply we don't want the far right and therefore we have no alternative?
Everybody came out to vote against the AfD, it seems. Yeah. But even then, they came a close second, 29% of the vote, it looks like. And it looks like this was not a victory for Olaf Scholz. Olaf Scholz effectively was told not to campaign in Brandenburg, which is where his constituency is. So a double blow, you can argue, on that front. They've squeaked through. They've just about managed to buy themselves a little bit of time. But it felt like a victory for the local SPD rather than the federal SPD.
Yeah, it absolutely did. And you mentioned Olaf Scholz as well. There are already some pushback from his party. You mentioned that they was act not to actually campaign, but there's already a conversation that the SPD could hold on to power if he wasn't a part of it. The replacement coming up as the defense minister, Boris Pistorius, as a potential option for him. Olaf Scholz is having a tough couple of weeks, couple of months, maybe a couple of years.
Well, we're about to find out. We're going into federal elections. That's what everybody's attention is now turning to. What is happening as we build up to those federal elections is critical. The Greens had a really terrible weekend. That kind of calls into question the coalition as well as to what is happening there. We've got a little while, potentially, until those federal elections. But the SPD is clinging on by its fingertips right now. And you do wonder whether those elections come early, and you do wonder whether or not he is going to be the choice to lead the party into that vote. Yeah,
absolutely. And this is just one of the regional government stories that we're watching in Europe.
Yeah, France, I think, is fascinating. So I think there's some parallels between what is happening in France and the UK. So let's deal with France first of all. We're going to get some live shots from the Matignon very soon. The new government is coming in. Barnier's worked very hard to try and form a government that he thinks can survive a vote of no confidence. But the vote is already being talked about by the left. The real question is, will the right back, i.e. Le Pen, will Le Pen back that vote of confidence against the government? She is definitely kingmaker in this whole process. But Barnier is also talking about the problems that the budget is, and you've flagged the budget for a while now, the problems that budget is going to pose to France and how difficult the situation is for that government. He's talking about tax rises. He was told that there shouldn't be tax rises, but he's talking about taxing the rich. That sounds very familiar here in the UK. Very similar message coming through from the Labour Party at the moment.
Taxing the rich with a cabinet that is the most far-right cabinet that France has seen in over a decade. I mean, it feels like a government of contradiction. I should say France is also, I know we're not talking about Spain here, but there is a read-through here, and that France is setting the tone for the rest of Europe in these budget negotiations by having that delay. Now you're seeing some of the periphery also pushing back on submitting some of their deficit kind of concerns, their budget plans to the EU as well. And I think that's concerning. But to your point, it's still that tax story. Nobody wants taxes on either side of the English Channel.
If taxes go, but the UK's, what has happened to the UK government is that they've seen a huge pushback against this kind of negative message of tax the rich, tax corporations. Yeah. Why should I invest in this country when that is the message that is being delivered? And it's a question that is resonating, I think, very much up in Liverpool right now. We've got the Labour Party conference underway. The new UK government has come in with a message of a downbeat message, a message of we've got huge problems in this country, we need to raise taxes, a message of gloom almost.
Yeah.
And business has had a real problem with that. Now, today, I think Reeves is going to try and fix that. She's going to come out with a message of positivity, that we have good times ahead. France and the UK, I think, are really interesting in terms of what is happening in both countries.
A message of positivity out of Rachel Reeves, who very recently had the exact opposite kind of take and message. But to your point of whether this country is investable, I guess the better question is, where else is the alternative? And it feels like that's the conversation that's keeping London investable, regardless of whether you're talking about corporates, investors from a macro perspective. You're still looking at cable at a 133 handle, Eurodollar at a 111, despite some of these deficit conversations and weakness that we're going to perhaps see in the data today.
But the papers are full of stories of people leaving the country, of people exiting to other tax jurisdictions. The UK is seeing more millionaires leaving the country. I think it's the second highest number than China, which tells you something about what is happening here. Now, there are many here, but there are many that are leaving. And it's getting the tone right is really important. They've come in with this kind of organised message of the Conservatives have left us with a huge problem. We need to sort it out. The budget hole is really bad. I'm surprised that Barnier is not noticing what's happening on the other side of the channel.
Well, what happened to Michael Barnier being like the diplomat who's going to come rescue everything? What happened to the conversation that the UK was going to be this island of stability or the safe haven almost? It feels like the tide is turning on a lot of these threads of positivity we saw a couple of weeks ago.
But it's really, really difficult for him.
Yeah.
Really difficult for him to knit together a government that can survive and thrive. And I think that's just a massive challenge for him at the moment in order to try and knit all these disparate forces together.
Yeah.
France is a mess still. I'm not sure that he's managed at the moment to deliver enough glue to knit it back together again. Anyway, we're going to talk more about that. We're going to talk much more about the Labour Party as well. The Labour Party conference is taking place up in Liverpool. We're going to be joined by the UK Chief Secretary to the Treasury, the Chairman of Llyoyds of London and the CEO of Ecotricity throughout the programme. Many big business leaders are in Liverpool for this meeting. Let's talk about what else we've got coming up on the show. We're going to cover the markets. We're going to be speaking to Allspring's head of rates and FX, Laurent Van Billon. We're going to be speaking at the Open to Karim Chedid from BlackRock, get his take on what is happening with these markets as well. And today is just the kind of the get-go. It's a really busy week. Got some PMI data today, but it's a massive week as well. Big inflation data out of the States at the back end of the week.
Yeah, we also have that Swiss rate decision on Thursday as well. And I mean, look, there's a slew of economic data that we're going to get. But to me, I'm still focused on the currency picture. I think the Swiss franc is really fascinating still in terms of the kind of haven bid that we're seeing. If we're talking about this island of stability, these politics being perhaps part of the problem and weighing on the broader story, is the Swiss franc, are Swiss assets, those haven assets, the answer to that? And I think that's where the U.S. story matters as well when we're talking about that week book. So, of course, the PMIs are going to be of concern. We've got UNGA as well. Plenty of conversations, plenty of comments coming from the world leaders throughout the entire week. And then that U.S. PCE number on Friday is also going to be interesting.
Expected to tick higher. Mechanically, it's expected to move a little bit higher. Is that going to take the steam out of the bond market rally that we've seen over the last few weeks? That's going to be interesting as well.
Yeah.
Is it going to take us back to the 25 territory that we were only a few days ago in, rather than this 50 territory which we now seem to inhabit when it comes to the Fed? What else do you need to know this morning? Let's talk about some of the other breaking news that we're watching this morning. Bloomberg has learned that Apollo Global Management has offered to make a multi-billion-dollar investment in Intel. Sources say the alternative asset manager has indicated it's willing to make an equity-like investment of as much as $5 billion in the chip maker, the struggling chip maker. We're told that nothing has been finalised and the size of the potential investment could change. You saw the Qualcomm news on this story as well. The exchange of fire between Israel and Hezbollah has intensified. The Lebanon-based group launching around 115 rockets and missiles and drones towards Israel's north on Sunday. Meanwhile, Israel says it has carried out a raid on Al Jazeera's bureau in the West Bank after concluding that the news network's offices there were, quote, being used to incite terror. And turning to China, the country has announced plans for a rare briefing by the PBOC governor tomorrow, raising investors' hopes that we are going to see more stimulus. This after the central bank moved to cut one of its short-term policy rates a little earlier today. That story is a kind of a little bit of a teaser. We're waiting to see whether or not they're actually going to deliver upon that story. But the market got excited earlier on that we're finally going to see some significant Chinese stimulus.
Haven't we seen this movie before?
I think we have, which is why I'm kind of, sounding a little cautious.
It's an interesting one, but it comes down to this idea that I think a lot of governments around the world are really dealing with, which is in the absence of real direction on the kind of geopolitical front and the fiscal front, is monetary going to step in and kind of rescue the markets? And I think it feels like everyone's on both sides of the Atlantic, kind of in a little bit of a waiting game. And I kind of feel like China is almost creating this roadmap that all these other central banks have to follow to some extent to keep this economy or any sort of economic resilience alive. You saw that with the Fed last week.
Absolutely. China needs a lot of help right now.
Yeah.
And maybe monetary policy is not enough to do all of the lifting. Could be in something of a liquidity trap. The steel story, I think, is interesting. European steel makers deeply concerned about the excess supply that is now floating around on the market. Yeah. You've got this story of the US potentially banning Chinese software in cars, which I think is fascinating. Will Europe have to follow suit on that one? That takes us back to the European car story. But I think we're going to potentially see this Chinese weakness once again showing up in the manufacturing PMIs, the PMI data that we're going to see out this morning out of France and Germany. I think both are going to be fascinating on that front.
Yeah, and you mentioned this idea of the pressure in steel makers specifically. Remember, Europe still has to fill quotas with the United States in terms of steel as well. So this isn't helping that you're starting to see this pressure from China as well in terms of supply, but then this demand story with the States as well. Europe, once again, caught in the balance of these two major superpowers.
And this goes back to the UK as well. How does the UK invest in infrastructure? How does the UK figure out to be better at it? The UK's got a huge challenge at the moment in terms of what it does with its steel industry, how much government money is going to be required there. Are we going to rely on others to provide the steel that the UK needs at a time when actually geopolitical insecurity maybe suggests that you do need some sort of infrastructure on the steel front just to make sure that you can have what you need, that your industry can have what it needs? And is government required to make those kinds of investments?
A lot to discuss on, it feels like so many European governments. Coming up, we're going to have all of that covered, starting with just this guy was talking about the UK. Of course, we are getting comments here from Rachel Reeves, speaking in a Times radio interview, saying there will be growth in public spending. Surprise, surprise. We'll perhaps get more comments from the Labour Party conference, covered with 3 live interviews throughout the show you will not want to miss. Plus, our very own Lizzie Burden on location. Plus, of course, the continent also in focus. French and German PMIs are due after the open in the latest round of fresh European data, as we discussed. But up next, a lot to cover in the markets today, including how investors are reacting to the latest political news out of Germany and France as well. If you have any questions for your own or for our guests, please send them to us. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Our monetary policy strategies have proved effective, mitigating trade-off between inflation and employment. If we enter an era where inflation is more volatile and monetary policy transmission more uncertain, maintaining the deep anchor for price formation will be essential.
ECB President Christine Lagarde talking about the risks and uncertainty facing the central bank in an era of more volatile inflation. Everybody's obviously in the United States right now. We're going to see a series of quite interesting commentary, I think, over the next few days. Maybe sort of updating us in the post-50 Powell era that we now occupy as to how monetary policy is going to change. Laurent Van Bion is head of rates and FX for the global fixed income team at Allspring Global Investments and joins us now. Good morning.
Good morning.
Nice to see you. Let's talk about, we're about to get a whole bunch of PMI data out of Europe. Is that going to tell us that the ECB should be doing more?
Yes, I think it absolutely will. It can be a little unfair sometimes to say that ECB is always fighting the last battle, perhaps not entirely inaccurate. And it feels that this LaGarde's focus on that upside inflation risk, particularly from services PMIs, is misplaced. They need to be thinking more about the manufacturing side and the downside risks to the global economy.
So should euro-dollar be where it is right now? Should European rates be where they are right now? Should we be pricing in significantly more?
Right now we're pricing in the most policy movement in the US, right, which is fascinating, given that,
exactly.
that nominal growth is still well above all its other developed market peers. And the ECB is starting from a slightly lower point. I mean, I take that point.
Yeah.
But yes, we should be pricing in more into European rates and into the euro.
Just to slightly follow up on that before Kriti jumps in. Should the euro-dollar be trading at 120, given kind of where, with the Fed delivering those kind of 50 basis point cuts, but actually in reality the market knows that actually the economic story is much worse over here, so it's trading in the kind of 111 area? How should I think about where we are?
Where should we? Yeah, I think the euro to me should be weaker. You know, I like some of the regional players, whether it's sort of euro versus Norwegian krone, which I think is still significantly undervalued. You know, the dollar is always harder to play purely because there's so much else happening in that cross right now, particularly on the political side of things. But yeah, I think the euro is being flattered at current levels.
What cracks that, though? I mean, how much worse do things have to get in Europe for us to see weakness in euro-dollar?
In euro-dollar? I mean, I think the key there is going to be that services PMI, isn't it? You know, we know the manufacturing one is weak. So if we start to see that services number really taking a step below 50, followed up by sort of more weakness in labour markets, that I think will do it.
Is the currency play reacting to the budget conversations, or is that its own thing?
I mean, currency is complicated. There's always a million things going on, depending on what you feel like focusing on the day. I mean, the budgets probably are playing a role, but there's very few crosses where, you know, one of the pair has a particularly good budget outlook.
Well, what about cable? I mean, we put a lot of emphasis on the euro-dollar right now, but we're seeing 133 on cable
133
as well.
on cable, yeah.
We're waiting the autumn budget. We're seeing a weird mix of pessimism but optimism out of the Labour government. What's going on with cable?
Cable is interesting, right? It's at full extended levels to me. I mean, on the All-Spring Global Fixed Income team, we actually sold our UK gilt position after that first BOE cut, and not really keen to re-establish right now. And if I had to pick a position on cable right now, you know, it's actually for sterling to weaken. I think we've priced in a fairly staged BOE reaction function, but we've got rate hikes, we've got tax hikes coming. I think the UK economy is vulnerable, and I don't think policymakers would be that upset to see the currency giving back some ground.
If the French government falls, which is a distinct possibility, can't be ruled out, is that a trust-like moment for OATs? Kind of, what are you looking at in terms of the spread over bunds
There's
at
that
the
British
moment?
optimism we were talking about.
Oh, yeah.
You can tell it's autumn and the nights are getting longer.
Yeah.
I mean, the trust moment was made worse by that budget that came alongside it, right?
Sure.
And the French landscape is characterised more by that sort of policy freeze. So maybe trust moment is too big a...
OK, how does the market react
if the
French government falls?
I mean, we saw it, we've seen it once, we'll see it again, right? Spreads will widen, we'll go back into that very tactical voting. Yeah, it does mean that you know, OATs will tend to underperform, particularly bonds.
And is that in the euro at the moment, or is that not in the euro price?
I don't think it is, no. I think the market has not been focusing on the idea of a French fallen government.
OK.
Does the German government matter at the moment?
It always matters.
We're just going from
to some
government
degree,
to
one
government
government to another. I mean, it's sort of an autumn of central banks rather than governments, it feels.
Yeah.
Does it? That's interesting, because it feels like the politics is taking over in the States, whereas we've kind of moved on from the Fed into the election story. The UK feels like it's a political story right now with the budget coming up and the investment conference coming up. We're worried about the French government. Scholz is struggling. It feels like politics. So do you think it's central banks rather than politics that are going to set the agenda? I
think into the autumn in Europe, absolutely. Which perhaps is counterintuitive, as you say. There's a fair amount of political risk on the landscape. You know, I think now that we're through this first cuts in the US, yeah, politics there is going to take far more of a front stage. Yeah. But in Europe, I think it's still going to be more central banks and policy, because we're waiting for that sort of aggressive pivot that we saw in the Fed and that we haven't seen yet in Europe.
When we're talking about the Fed, though, and it feels like, let's just circle it right back to the States. And Guy was talking about this geopolitics as weighing on all of it. If we go back to, say, the Trump era, which I think a lot of people are bracing themselves for, so much of that did show up in the dollar trade in terms of tariff implications, in terms of deficit implications. Do we follow that same playbook going into 2025 when we do have, by the way, a debt ceiling that we're hitting on January 10th, 10 days before the inauguration? I'm obsessed with this fun fact. Nobody seems to care except for me. But then you also have this tariff story that people are so accustomed to. Does that create a dislocation in dollar positioning?
Now, that's an interesting question because dollar positioning had been very extended.
Yeah.
But a lot of that had, I think, been in the yen. And I think the short squeeze we saw over the summer did clear out a lot of that extreme positioning in the US dollar. So really, to me, dollar positioning is fairly neutral right now. So there is room for that to be rebuilt into November, into the end of the year, if politics do go the way it possibly could. And we have to start thinking about, tariffs again and immigration controls, et cetera, et cetera.
But is that an actual tradable data point?
Is it a tradable data point? It's a difficult one to trade.
Yeah.
I mean, there's certainly a very active market in trying to find proxies for polls and how to trade them, whether it's solar panel stocks or whether it's Trump media. And those are giving conflicting signals, which maybe sums up this election fairly neatly, right? On a knife edge and could go either way.
In terms of the near-term story, though, for the Fed, is the expectation we've done 50, now we do 25s? Is the data going to take us back towards... How is the bond market has priced a loss in, and we've got an awful lot priced, and we've got sort of sequential 50s potentially on the table. For instance, if we get a core PCE number this Friday that signals that actually inflation is stabilising, maybe even in danger of re-accelerating at this point, how does the bond market react? How violent could the bond market reaction be? If the data if the surprise index, which is already bounced, if you look at the City Surprise Index, it's already starting to improve. If the data start getting better from here, how dangerous is that for the bond market?
This is going to be a really interesting month, a really interesting week of data, because as you say, PCE could go either way. And we know the Fed's made it very clear their focus right now is labour market, not inflation.
Yep.
But how far could they look past a re-acceleration? You would think not too far. In that sort of circumstance, you would think steeper curves, and you would think long end sort of underperforming in a fairly significant way.
Yeah.
Right. Curves do look fairly flat anyway.
Yeah.
Is it going to be bull steepening or bear steepening? The data's going to...
Which do you think?
I mean, I'd love to see bull steepening.
Yeah.
But I think there's certainly a risk that it's the bearish
where the
side.
deficit plays a role, doesn't it? Right back to the fiscal conversation. I love this. Lauren Van Beyond will leave the conversation. They're head of rates and FX for the global fixed income team over at Allspring Global Investments. Redhead crossing the Bloomberg terminal at the moment. CVC Zabka announcing the intention to float on the Warsaw Exchange. Now, look, this is important because CVC, of course, one of the major private equity players in this region. Zabka is a Polish grocery chain. The fact that there are actually listing...
Sorry, is that an exit? I haven't seen one of those for a while.
Exactly. And I think let's broaden this out because this is a big one. This is when we talk about, especially in the private capital markets, that this is where you're starting to see some of the glut, some of the positioning story, that nobody's actually able to move in and out of these capital markets. And that's why you have so much dry powder basically wrapped up in these private markets. Is CVC setting the tone here, perhaps?
Well, finally, the question is, are we going to get to a point where some of these private equity firms are more price intolerant, i.e. we just need to move this.
Yeah.
We need to accept that what the market is telling us and take the price that the market is offering us for some of these exits. Anyway, it's a question. It's interesting to see. You don't see many of them at the moment. We are going to speak... Who we got next? Darren Jones is going to be joining us. Chief Secretary to the UK Treasury. Lizzie Burden is going to be speaking to him at the Labour Party conference up in Liverpool. That conversation is coming up next. Plenty of great coverage from that conference. This is Bloomberg. 30 minutes from the start of equity trading here in Europe. Remember that Japan closed today. What that means is that treasuries don't start trading until the European session really kind of kicks off. We're starting to get a price now. Let's just give you a quick idea of what the session is looking like already in the equity market. Then we'll take a quick look at what's happening with bonds. I think we are becalmed. We're looking for guidance. Where does that come from? Look at what is happening with the Euro stocks, the CAC futures and the S&P futures. No real sense of direction this morning. Where does that catalyst come from? The data later on in the week is going to be interesting, but the politics here in Europe, certainly at the beginning of the week, absolutely fascinating. At the moment, we have bonds bid in Europe. So you've got Germany a little bit bid, so you've got yields moving a little bit lower. Treasuries are moving a touch higher, which is fascinating, but we are awaiting PMI first out of France and then out of Germany. But at the moment, Kriti, it's the politics that are front and centre.
Yeah, that spread between the French and German debt. We're looking at something at 76, 77 basis points in terms of the spread this morning. And as you say, it is a busy weekend for European politics. German Chancellor's party narrowly avoiding defeat in state elections. Meanwhile, over in France, a new government unveiled late on Saturday. Let's get the latest on both stories. We'll get to France in a moment with Julian Pontus out of Paris. But first, let's get more details of those elections in Brandenburg with Bloomberg's Oliver Crook in Berlin. Ollie, let's start there. How much of what we saw in Brandenburg over the weekend was a vote of confidence in the SPD, or was it more a kind of pushing away of the AFD? How are you interpreting it?
Yeah, so listen, I mean, when you look at the actual results here, so it was the SPD coming in at 31%, the AFD coming in just over 29%. I mean, this is a victory from the SPD, yes, on paper, and in reality by just under 2 points, right? This is sort of an important section of Germany because it is the area that it surrounds Berlin, but it's also an area that has been held by the SPD since the 1990s, since reunification, uninterruptedly, right? So this is a very, very sort of stronghold for the SPD. If they were to have lost this, I think there would have been a lot more conversations that accelerated around if Scholz was potentially the right candidate to lead this sort of party into the next election. The fact that that did not come to pass is a bit of reprieve yet, but it's hard to call this a major victory, right? The AFD, the far right, and this is one of the chapters of the far right within Germany that is considered an extremist group by the German intelligence agencies, doesn't really give a huge amount of confidence boost to the SPD and the governing coalition. We should say the other two parts of the governing coalitions from this results both got so few votes that neither of them will be in the local parliaments. So not exactly a sort of vote of confidence there. But I think that, you know, on the balance, this is avoids the worst case scenario for Scholz. But I think that in the sort of lead up to the election that is coming in 1 year and 1 week away, this does not silence sort of with totality whether or not Scholz is the right candidate to lead the party into the next election.
Ollie, stay with us. We need to talk about French politics as well. We've got live pictures coming from the Matignon this morning. We are going to see the outgoing government and the incoming government effectively swapping over. We'll get various pictures being taken. But we have a new French government. The question is, how long will that French government be able to survive? Julian Pontus joins us now from Paris. That's the question, Julian, isn't it, this morning? I'm already hearing rumblings that potentially we could see a vote of confidence in this government. How stable does it look?
Not stable at all, if you ask me. Yeah, it's anyone's guess if the government can last more than, you know, a month, a week, or just until the beginning of October, where we could have a vote in Parliament of confidence that the government could lose. More interestingly, we do have a government, and we do have a pledge from the Prime Minister to take the deficit issue seriously. So they've announced that they will be raising taxes. I guess that's trying to prevent a Liz Truss moment in a way, so that for foreign investors, basically nothing changes in a way. This is no game changer. You still have France with a big deficit, but you have a government which is going to look into it. What you do have is no visibility on the political front. So I don't see basically the discount that you have on French stocks, on French bonds going away. But there's no reason for a foreign investor to sell everything immediately. So it's a bit of a status quo. You have little visibility, but you don't have any extreme scenarios, you know, likely immediately. So in a way, we're a bit stuck in a wait and see what the government, if the government can survive these past the next weeks, I mean.
And as we say, you're looking at live pictures coming from the Matignon, the Hotel Matignon, where the French Prime Minister resides. And as we get pictures of the incoming, outgoing governments, we'll bring those to you throughout the morning. Guys, thank you very much indeed. Oliver Crook in Berlin, Julian Pontus in Paris, covering the politics for us. Let's continue with the political conversation. Rachel Reeves has told Times Radio within the last few minutes there will be growth in public spending going forward, i.e. no austerity for the UK, which has been something that the political classes have been chatting around. The papers have been talking about the idea that actually this is a downbeat story economically coming out of number 11 Downing Street. The UK Chancellor is due to address, of course, the Labour Party conference later on today. Bloomberg's UK correspondent, Lizzie Burden, is in Liverpool for us. Lizzie.
Yes, Guy, it's business day here in Liverpool at Labour Party conference. It's their first in power in 15 years. And really, Keir Starmer trying to hit the reset button because the headlines have been dominated by stories of infighting at number 10, freebies. But also they want to hit the reset button on that gloomy economic narrative. Of course, on Friday, you had GFK saying that the anticipation of a painful budget on October the 30th has been denting consumer confidence. So we'll hear from the Chancellor, Rachel Reeves, in her speech later today. But I'm pleased to say we're joined now by Chief Secretary to the Treasury, Darren Jones. Darren, welcome back to Liverpool. You're in government now. I have to say, the headlines are dominated by these stories of infighting and freebies. It's the sort of thing that you would have said months ago held back investment if it were the Tories doing it. Are you frustrated that the distractions have kicked off the conference?
Well, look, I think if you look at the front pages today, as we wait to hear from the Chancellor in her speech later, it's very clear that the whole of conference and indeed the media now is focused on what the Chancellor is going to say. This is an important speech at party conference, as it always is. And she'll be very clear that the Labour Party was elected into government because we are now trusted on the economy and with public money, and that by making difficult decisions to get our public finances under control, we can start to deliver on the promise of change.
Well, we're told to expect a positive message from Rachel Reeves today. Is that an acknowledgement that your economic narrative hasn't matched the data and it's actually weighing on consumer confidence?
No, our manifesto had the word change on the front. We always came to this election seeking a mandate for change, which we very handsomely secured, as you saw with the election results in July. When we came in, we had to be honest with the public about the mess that we were left by the Conservatives, the £22 billion black hole where they had signed up to bills but hadn't put the money aside to pay for them. But because we're trusted on the economy, we had to get a grip of those public finances, and by doing so, we're now able to start that process of change and to invest in the country.
I mean, GFK specifically said that the anticipation of a painful budget was what weighed on consumer confidence. You had Bank of England Governor Andrew Bailey even more upbeat than the Chancellor on Thursday, explaining why we didn't cut by 50 basis points when the Fed did. Does it the fact that actually it makes political sense to roll the pitch for the budget, but it doesn't actually make economic sense? It doesn't match the data.
I think it was really important for the market as well as for the public to know that this Labour government had a plan for getting a grip of the public finances that got completely out of control under the last Conservative government. We've never been in a situation before where there was £22 billion of unfunded bills within the fiscal year. So we had to show very clearly that we had a plan to get a grip of that, to reset those budgets, which we'll see at the budget on 30th of October, and then start to deliver on our priorities.
But I mean, colleagues of yours have talked about a run on the pound if you hadn't removed the winter fuel allowance for all but the poorest pensioners. I've spoken to FX strategists who say that's nonsense. Do you accept that it undermines your economic credibility?
No, I think what Lucy Powell was trying to illustrate there was that we've already got a very high debt burden as a country. That debt is expensive. And if we couldn't show to the market how we were going to get a grip of those public finances and just result in borrowing money to pay it off each and every year, the cost of those gilts would have gone through the roof. That would have been expensive for the government, and that is not the right priority for taxpayers' money.
Well, if conference votes down the move on fuel allowance today, would you U-turn on it?
No.
And if you were told, well, we're going to be told that it's not an austerity budget, but does that mean you'll lift the cap on two-child benefit?
We can't afford to do that right now, but we have put together our child poverty task force, which is trying to get to the real root causes of child poverty and why it's rising in this country. These things aren't easy to fix with a magic wand. There are lots of structural reasons in the economy that children are living in poverty, and we've got to tackle those issues.
To some, that will seem like this is an austerity budget. Let's focus on business now. We've had wealth creators telling us that they're considering leaving the UK because of what your budget will hold. Will you rule out equalising the rate of capital gains tax with income tax? tax?
You know the answer on all tax questions, albeit it's a decision for the Chancellor at the budget on the 30th of October. But what we can say to investors is that growth is our first and most important mission. We've recognised the need to work in partnership to bring investment into the country, and the Chancellor will be setting out a budget to do just that.
I mean, I'm sure you can understand business has been waiting for detail for a very long time. You've already been in for 3 months. We've got to wait now till October the 30th. Do you understand that the longer you make them wait, the longer they'll put off investment?
I think business recognises that we have to get back to business as usual, which means getting an independent forecast from the Office for Budget Responsibility. You have to give them 10 weeks to do that before you can have a budget. October the 30th is as soon as we could do it. We must not go back to the times of Liz Truss where you start putting budgets through with no funded policies and without having OBR forecasts.
So hypothetically, our economists calculate that the BOE's recent decision on rates and QT gives you £4 billion of extra headroom. If that is confirmed by the OBR, would you be less tough on those with the broadest shoulders?
Well, look, anything of that nature will be factored into the Chancellor's decision in the budget as we look at the economy in the round. We will announce spending for the next financial year at the 30th of October, and then the Chancellor will set the spending envelope for future years, which I will then distribute through the spending review after the budget.
I'm sure you saw that letter from the 8 leading economists last week asking you to rip up the fiscal rules so that you can borrow to invest more in the public infrastructure. And I don't expect detail, but can you at least say that some sort of reform on the fiscal rules is coming?
So the fiscal rules that we were elected on are the fiscal rules that we will deliver on. That's about getting day-to-day spending in line with tax receipts and about bringing down debt as a percentage of GDP in the medium term. And the Chancellor will set out the full detail for those fiscal rules at budget as part of the Charter in the normal way.
I'm just trying to understand the big picture strategy for this growth mission. How long are we going to be in the fixing the foundations phase? How long do we have to wait for you to put the tens of billions of pounds that your economic advisors say is needed to crown in private investment? Will you have to wait till the second term?
No, we can get on with fixing the foundations now, which is about getting a grip of the public finances and starting to invest in our country again. And then we will set out in the budget and the spending review how we will prioritise and profile the delivery of our manifesto commitments over the coming months and years.
I mean, at the Mays lecture, the Chancellor was railing against this stop-go cycle of capital investment, and yet she's suspended road and hospital programmes. She's told departments to find £3 billion of savings this year. They've come back with proposals to drop a £500 million AI plan. How's that firing up the economy?
Because we've committed in our manifesto to a 10-year infrastructure strategy. We're returning to multi-year spending reviews, reviewed every 2 years, and those plans will be aligned with our spending review. So from the budget in October through to the spring in 2025, those stable foundations on policy and public spending will be set for the rest of this term in office, and we will not return to the behaviour we had under the last Conservative government of instability in policy making and spending commitments.
Just finally, there seems to be a rift between the Chancellor talking about turning up to the Treasury in person because that's what she wants others to do, and the Business Secretary saying that giving people the right to work from home makes them more motivated and resilient. Where do you stand?
Well, I work for the Chancellor, and so I'll be going to the office.
With your tie and everything.
Absolutely right.
Darren Jones, Chief Secretary to the Treasury, lovely to have you. Good luck today. And back to you in the studio, Guy, as we await the speech from Rachel Reeves, with maybe some clues on what that October 30th budget will hold.
Yes, but we needed the numbers from the OBR in order to put the final finishing touches to that. We've waited a long time. Can we wait much longer? Fantastic interview, Lizzie. Thank you very much indeed. Lizzie Burden joining us from the Labour Party conference in Liverpool. Let me tie that story back into what we are seeing in France and take you back to the live pictures we're seeing from the Matignon, the home of the French Prime Minister, currently occupied, of course, by Michel Barnier. Barnier's talking, apparently, opening the door to taxing wealthy individuals and large companies. He is trying to repair France's massive budget deficit. He's trying to reassure international investors, Kriti, when it comes to the bond market. But facing, you could argue, the same challenges that the UK government is facing right now, i.e. business wants a positive story. Business wants a case for why we should invest into this particular country.
Yeah.
And it's taxing business, is taxing the richest, going to deliver that investment that maybe Barnier, maybe Rachel Reeves is looking for in the UK and France?
You know, we keep highlighting this division between traditional kind of right-leaning politics, which is no tax increases, tax cuts even, and the fact that they need to do that to really tackle this deficit story, which, by the way, was one of the reasons business wasn't actually pursuing a Le Pen agenda as well. There were a lot of concerns around the deficit and what that actually looked like. Is this the answer to that? potentially? Is this meant to be a little bit of a reassurance in that regard?
But it brings to an end this Macron era of trying to woo business, trying to encourage business to come in, trying to provide tax stability, trying to provide all the things that businesses asked for from France for generations. He's tried in some ways to provide that. But now that appears definitively, if Michel Barnier is talking about this, to be coming to an end. As we look at pictures coming from the Matignon, clearly the cameraman repositioning. We'll bring you live pictures if we're starting to see the outgoing and incoming French governments showing up on our screens.
Yeah, a really interesting one. We're going to keep an eye on the ripple effects in the bond market as well. But coming up on the program, we're diving right back into the stock market. REA has sweetened its offer for property portfolio Rightmove to over £6 billion. That and more in our stocks to watch next. Stick with us. This is Bloomberg.
Monday morning, good morning. 11 minutes to go until the opening trade here in Europe. European equity markets not giving a clear sense of direction this morning, but there is green on the screen. The futures are telling us we may see a positive open. One potential reason for that could be that we are about to see some Chinese stimulus. We are now anticipating that there will be a key meeting tomorrow, a key press conference tomorrow, effectively, with some of the senior officials from the PBOC. There's much anticipation about this. Let's figure out exactly what we can nail down and what we know at this point. We're joined now by our executive editor for Asia Markets, Paul Dobson. Paul, there's a lot of anticipation about this news tomorrow. What are we expecting? What is the market thinking may happen?
Yeah, good morning, guys. So market's getting very excited about this briefing that we're having tomorrow by several of the Chinese regulatory authorities all at once, including the central bank, being held before market open. So a couple of things that tell you that it may be offering some kind of supportive measures for financial markets. Remember, the PBOC quite recently vowed that it was going to do more to fight against the risks of deflation. And we also heard that some of the briefings given by top government recently have been about trying to reduce financial risk. The problem is China, it looks like it's on course to miss its growth target of about 5% for the year. So need to do something about that to set the course back right. And what people are probably expecting here is a package of measures. It's not entirely clear exactly what that will look like, but some kind of reductions in interest rates seem likely, some kind of reductions in mortgage rates as well, which may help the housing market somewhat. But on the other hand, what we're not really expecting is some kind of big bang stimulus measure necessarily. That's not probably priced into the market. Market is willing to be disappointed, having been let down so many times before, because basically the Chinese authorities are happy to get to the 5% growth rate, but don't really want to push things a lot further and to inflate market risks too much more than that.
Well, Paul, if we do get this come through in the next 24, 48 hours, where does it show up and how quickly does it show up?
Yeah, so I think, interestingly, it may give some support to the equities market. It may also continue to weigh on bond yields. And remember, China also told us that it doesn't want bond yields to go too low or for there to be excessive risks, particularly at the back end of the yield curve. So there may be a resumption of that tug of war, that tussle between investors that want to buy those bonds and the authorities that want to keep the yields elevated. We're around the 2% level on the 10-year at the moment. Haven't fallen below that yet. So that's one area to watch, as well as the equities markets, for some kind of support. Remember, Chinese stocks have had another drubbing in recent months, trading at 5-year lows on the mainland. So it doesn't take too much to lift sentiment there. Nonetheless, whether we will see something that really powers one of those bull markets remains to be seen.
Paul, we're waiting European PMIs. They're about to start dropping onto our screens within the next half hour. China is actually going to be a big feature of this landscape, both in terms of the French numbers and certainly with the German numbers. What are we expecting?
Yeah, so I think that the forecast for the PMI figures are predicting a little bit weaker manufacturing and quite significantly weaker services numbers relative to what we've seen recently. It's a slowdown on the services side. It's contractionary territory on the manufacturing side. So still that gloomy cloud hanging over the European economy. But for policymakers, there's still that dual thing to consider because inflation remains sticky as well. And so for the ECB, they still have to continue to sort of balance these risks about slowing growth along with the inflation inflationary picture. We're expecting to see more cuts coming through in the rest of the year, of course, that may support markets, but it's not clear exactly how fast they'll be able to implement that.
Certainly something we're going to be keeping our eye on. Paul Dobson, we thank you so much. Our executive editor for FX and Rates joining us out of Singapore. We thank you. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we're keeping an eye on Rightmove today. This is after Ria Group in Australia raised its bid once again for the property portal that's listed in the UK. Ria Group saying that it's genuinely disappointed that Rightmove's board hasn't engaged over this deal, and point out that Rightmove's share price has actually been pretty flat over the past couple of years. As we can see, there's the spike from the initial bids that we've had from Ria Group, but about £1's worth of upside in terms of where that latest bid has come in. So we would expect that to be a bit of a mover today. Then we're also looking at Commerzbank, the German government saying that they won't sell down any more stock for now. That this is a really big reversal from what they said a couple of weeks ago when they said they would push through the eventual exit of the bank. Now, this is, of course, to fend off this potential takeover from UniCredit. Here's the two stocks on the screen. Almost a 20% gain in Commerz. We've actually seen a bit of a rise in UCG as well, but Commerz is the one to watch today of those two. Then over in luxury, more downgrades. This time we're seeing them from Bank of America, which cuts its ratings on LVMH and Kering down to neutral this morning, and it is also going underperform on Hugo Boss. Now, this follows a number of banks last week downgrading earnings estimates for the sector. We saw Goldman, Jefferies, Morgan Stanley cutting their estimates. BofA adding to that today. Keep an eye on those stocks, potentially more downside to come.
Joe, thank you very much indeed. Joe Easton with the single stock story. 5 minutes to go until the equity market open. Mild positive, maybe priced right now. We'll deal with the details in a moment. This is Bloomberg. Monday morning, good morning. Couple of minutes to go until the opening trade here in Europe. Let's talk about how Friday's session is going to influence Monday morning. We went out in Europe at session lows in the United States. As you can see here, blue line is the US session, white line is the European session. We went out at lows, we climbed a little bit higher. That's why, in many ways, we are seeing the futures picture positive this morning, despite actually maybe some negatives to think about and maybe priced in here in Europe. So futures at the moment reasonably positive. We're not up by much. We're up by a little bit. Eurostoxx futures up by 0.2%. FTSE's up by 0.1%. But we are just in the green. But you do wonder whether or not anticipation of the PMIs is going to be a factor for Europe to price in this morning. Nasdaq futures, though, not much higher. But remember that they closed higher than where Europe was. So you've got to factor that into your thinking, Kriti. But at the moment, feels like a front foot story, but only just.
It does, and there are a couple of individual movers we've got our eye on as well, specifically when it comes to the M&A space. REA, of course, is top of mind. We have that offer coming out from Rupert Murdoch's company for Rightmove. £6 billion seems to be the offer on the table. We'll see how that shakes out. It's not the only one, of course, we're keeping an eye on. Commerzbank, UniCredit, how much pushback does Germany actually able to really execute, and how does Andrea Orchel actually pay attention to that is one we're going to keep an eye on. Remember, major pushback coming Friday and aftermarket. And of course, luxury stocks getting a lot of pain, not just LVMH, Kering. Joe was talking about Hugo Boss as well. All of those are going to be in focus, guys. We talk about not just the entire sentiment, but of course the read-through as well from the Chinese story into the French markets.
Okay, here we go. Monday morning, we have got the opening trade. We're expecting a mildly positive open. I think it's going to take a while for the CAC and the DAX to open this morning. Plenty of single stock stories there. So here we go. Here are the numbers. Here's the opening trade. We're expecting mixed, I think, probably at best out of Europe. Already starting to see a little bit of that. FTSE 100 floating in and out of positive, negative territory, flirting with the flat line. It's going to take a while, I think, for the DAX to get going this morning. You've got to think about Commerzbank. You've got to think about what's happening in the luxury space. You've got to think about that luxury space as well when it comes to the French market as well. So the FTSE 100 now actually turning a little bit negative. Stock 600 a little bit positive. No clear sense of direction emerging from Europe this morning. There's the CAC, absolutely flat. I'm fascinated to see what is happening with LVMH and Kering this morning on that downgrade from Ashley Wallace. Let's talk about where we are with the DAX. I think it could take a few minutes maybe to get the DAX open this morning, Kriti. There's a lot to think about as we wait the PMI data out of France and Germany.
We'll certainly keep an eye on that. But in the meantime, let's get a quick check on how these markets are actually moving, because you are seeing, it looks like right off the bat, some of the luxury names starting to see a little bit of pain, at least on the stocks. We're waiting for that to shake out with the French indices, as you point out as well. But right now, one of your biggest downside moves from an index contribution perspective is AstraZeneca. To the upside, Novo Nordisk from an index contribution. It's a tale of two pharma.
But this is what seems to be happening on a daily basis at the moment. Within the pharma sector, we seem to have this rotation out of names like Roche and Astra into Novo Nordisk, then almost back the other way. So I think that's fascinating. We've got this BNP Paribas news as well, relating to the fact that it's buying the German private banking unit from HSBC, which is worth bearing in mind as well. Let's just go back into the single stocks and see what is moving this morning. The China story will be a factor, I think, maybe for the commodity names this morning. So you've got to bear that in mind as well. So let's just talk about, as Kriti says, what we're seeing. Rightmove is up. 3.5%. That seems to be on the back of the story that Joe was bringing us. But as you say, Astra, Roche, Novartis, all softer, but LVMH is down.
It is.
Not by much, though. I wonder whether what we're seeing is the downgrade being offset by the expectation of more easy times maybe coming out of China.
Yeah, it absolutely could be. You mentioned HSBC as well. You are seeing it be you're one of your top Eurostoxx 50 performers this morning as well, and your biggest index contribution to the upside on the FTSE, even though broadly you're seeing the FTSE underperform the other indexes this morning. HSBC seems to be the outlier, so that's going to be one. And then your favorite, let's talk luxury here. You are seeing some pain in Kering and, of course, LVMH as well.
Absolutely. So we've got the downgrade for Bank of America. You've also, Stifel, I think, is out with the downgrade as well this morning, so bear that in mind as well. This is a multi sort of pronged story. Will more positive news out of China offset that? We're going to see services data also out of Europe very shortly too. But it feels like a defensive market this morning. Nova's up, Nestlé's in terms of the kind of the positioning where actually the money's flowing in terms of the points. Novo's up the most, then Nestlé, then Total. HSBC, the banks are up, but SAP's in the mix there as well. So you've got a bit of luxury, bit of commodities, and some of that defensiveness coming out of the out of the pharma sector. But the pharma sector is kind of, Astra, as you say, and Roche are both soft. It's
a fascinating kind of market reaction that we're seeing this morning. It feels like a million different threads that we could pull out. Let's get a little bit more analysis here. Kareem Shadi joins us around the table, head of investment strategies for iShares EMEA over at BlackRock. Pleasure, as always, to have you. Good morning. Like I said, we have so many things going on in today's market. I'm curious what you think is driving the trade right now, or will be at least through the end of the year. Is it the fiscal? Is it the monetary? Is it the budget? What's top of mind for you?
Yeah, I think if the big picture is when we look back at, and we're in the last week of Q3, when we look back at Q3, is that the direction for equities has been up, but it's not a straight line. You know, we have some bumps along the way, and it's interesting to see in this swoon in August that bonds did have a chance to prove themselves and provide some ballast on the days where equities were down. And as we look forward from here, I think really important will be the macro picture. We're probably going to get a bit of a mix on this from the PMIs this morning in Europe, given that we have a bit of a two-speed economy going on. Structural decline in manufacturing, green shoots in services. I have a question mark on how far those green shoots are going to last.
How much of that in Europe specifically is contingent on, say, the election outcome of the states? And I ask this because I was in New York last week, and the conversation on the ground is so different than in Europe, which is that regardless of the election outcome, people still expect stocks to go up. I don't think you can make that argument here.
Yeah, I think in Europe, the key drivers for the European equity market are going to be some of those idiosyncratic stories that you're talking about this morning, which is why I think there's plenty of alpha opportunities in Europe. Unlike the US, where we still see the index returns really the big driver, top-down macro, in Europe, there was alpha stories, those idiosyncratic stories within sectors and within the market do matter. On the macro picture, we do have tailwinds in Europe. You know, even if you put the election uncertainty to the side for a second. And there I would be looking at the trade beta. So, for example, just on that, UK equities have low trade beta. So we're seeing some of our conversations with investors look at buying UK equities in that context. But in the continental European space, I think the macro tailwinds are coming from this ECB rate cutting, potentially accelerating from once a quarter this year to faster next year.
And is that good for stocks or bad for stocks? Why is it good for stocks? Because it would seem that is, unlike in the United United States based on the idea that the economy is slowing down, which doesn't sound great for equities.
I think it's good for stocks in the context of, easing is good for stocks, and the European economy is still more sensitive to rates than the US one. So you see this lag is shorter from rate cut.
Why is easing good for stocks when tightening was also good for stocks?
Well, tightening was good.
Stocks always go up.
Stocks go up over the long term, which is why you don't want to time the market. You stay invested. This is always our view.
But there's an argument for, if we're easing policy, we were tightening policy, stocks went up, and now we're easing policy and stocks are going to go up.
I think it depends why you're easing. If you're easing because growth is falling off a cliff, that's unlikely to be good for stocks. If you're easing because you have enough deceleration or stability in wages and inflation, and the macro is weakening but not falling off a cliff, that can still be good for stocks. And I think this is what we'd be getting.
But I can apply that argument to the States. It feels like you can apply the argument to the States that inflation has come down sufficiently for the Fed, despite what is happening on the growth front, to be able to actually manage to cut 50 basis points. The ECB comes out and cuts 50 basis points. People are going to assume it's because we've got a growth scare.
Exactly. So I think you're right that the Fed managed to cut that 50 basis points without creating a growth scare, which is why stocks have been up despite that. The difference between the US and Europe for me is that in the US, we still have a macro story. So you can buy the market, the broad market, the index. Whereas in Europe, I see stocks struggling to outperform the US on a broad level. But this is where the alpha opportunities start to matter, the stock picking.
But the European stocks that have outperformed, say, their American counterparts are the ones that have engaged in buybacks, dividends, excess liquidity. And you've seen that across various sectors. You see it in the pharma sector. You've seen it in the banking sector, famously. Walk us through how long that lasts, though.
So, I mean, valuations are cheap in Europe. They're not very demanding. And that is part of the reason why we've seen these pickups in those strategies. Also, from a broad investment perspective, there's a question about income investing, speaking about dividends. Do you buy equity income in the context of rates starting to come down? Or do you rush to buy fixed income before those yields come down? And to my mind, I think it's a bit of both. You want to lock in the yields in bonds. So we're starting to see these focus on fixed maturity bond exposures because of this urgency to lock in yields as rates come down. Whereas in equities, it's really those quality income strategies that you're after. So you don't want to just chase dividend strategies for the sake of it, where it's value, it's a value trap.
Stay with us. We've got a few more things we need to be discussing. Kiran, Head of Investment Strategies at iShares EMEA at BlackRock. Quick look at what is happening with the Core 6 right now, just to give you an idea of what we're seeing across Europe. This is the picture, as you can see, a single stock in the red, that downgrade from Bank of America, seeming to do some damage to LVMH this morning. But elsewhere, we are positive, but not by much. But I think it's the defensives that do seem to be on the front foot this morning. Look at how Nestlé is performing, up by 1.34%. Let's get back into that Rightmove story as well. We need to talk about that. Joe Easton's here with the details.
Rightmove, guys, actually the best performing stock across the entire stock 600 this morning, following news of this increased bid from Ria Group over in Australia. Now, remember, it was $7.70 a share in terms of the cash and stock offer. But look where it's trading. It's trading below 700 pence, meaning that lack of engagement from Rightmove's board does seem to be a stumbling block for a deal moving forward. But nonetheless, moving up around 3% at the moment. Then the other big M&A story, of course, is Commerzbank. The German government saying it will not sell any more stock for now. Now, RBC Capital writing in a note that a full takeover of Commerzbank by UCG now does seem less likely, given the German government is unwilling to sell more shares into the market. We can see UniCredit coming down around 0.6% as well today. There's a couple of drug stocks to bring you now. Novo slumped last week, but also AstraZeneca, because we've got some drug data out of Astra over in Asia. Their joint venture oncology partnership reporting yet weak data in one of their key trials overnight. But as I was saying, Novo, we saw a slump last week on one of their trials data relating to an obesity pill. So it would be an alternative to Wegovy and Ozempic. That was weak, so we're seeing that stock coming up a little bit now. In terms of the worst performer in the UK, now this one not really on our radar, but take a look at that drop, down 32%. This is Alpha Wave, a supplier into the semiconductor space here in the UK, worth about £1 billion. So not the smallest company, but a profit warning related to competition over in South Korea. So absolutely slammed for that stock. Was going to check in quickly on the miners. Another 3% drop in iron ore overnight, weighing on some of those stocks related to some weak Chinese government data that we saw overnight. So we are seeing a little bit of weakness in the London miners like Glencore and Rio this morning. But then finally, those rating changes, we mentioned LVMH also carrying, also Hugo Boss underperform at BofA. BofA downgraded its earnings forecast for about 17% across the entire luxury space today. So that one is down 3.5%, underperform at Bank of America. More positive, though, in the UK retail. We've got a note from UBS upgrading a couple of stocks, saying that the earnings statement from Kingfisher B&Q last week is potentially a strong signal for UK retail. One of them they like is Dunelm. They go up to buy on that one, and we're up 2.3% on that stock this morning.
All right, Joe Easton from our equities team walking us through some of those early movers. We thank you so much. Coming up on the program, we're going to speak to Llyoyds of London chairman Bruce Carnegie-Brown live from the UK Labour Party conference and, of course, break down that European PMI data next. Stick with us. This is Bloomberg. Welcome back to the opening trade. We are getting data coming out of France, dropping on the Bloomberg terminal as we speak. September services PMI falling to 48.3 from a 55 previously. The manufacturing PMI, however, rising to a 44 from 43.9. Guys, these are not good numbers.
No, they're not. I'm just I'm trying to get onto the website to try and get some details on this. It's asking me if I'm a human, so believe you me, I am. Just trying to get some details. But yeah, no. Look, so the manufacturing number. Is that a pickup? 43.9 to 44. That's still a fairly bleak number in my my read. The services PMI drops into contraction territory from 55, which is a fairly decent number, to 48.3. The market there, the economists were anticipating 53.1. The composite number drops to 47.4. I wonder how much of this has been. I wonder how much of this is post Olympics. The last number, remember, on the services front was very strong. That felt like it was an Olympic-induced number, a Kriti Gupta-induced number. This feels like a sort of opposite reaction to that.
Yeah.
I also wonder whether you sort of you put the politics into the mix as well, whether that's also a factor in this. But the services slowdown is significant. The manufacturing data looks stable, but this feels like a post-Olympics number to me.
And that's exactly what the folks over at S&P Global are actually citing it as is. They're saying that, look, this is where the pain and the customer numbers are actually showing up, whereas the move in the manufacturing production story, it is still at the sharpest pace since January. You're still seeing a drop. Kareem, let's bring you into the conversation. What's your initial read here? How do you interpret the weakness?
I mean, specifically on the services number, I would agree with Guy's analysis that it does have to do with the Olympics. We saw that bump earlier in the summer, and we knew this will normalize. So I do need to see that drop into contraction for services in that context. But I think the big picture is exactly what I was laying out earlier, and something that I'm a bit worried about in the European macro. The pickup in the structurally low manufacturing sector, the structural decline in manufacturing that we're seeing in Europe, that pickup is not going to be enough to offset the waning green shoot that we have in services. And if we bring into the mix the broader European data that we're going to get later this morning, you have to look at Germany as well, where the auto sector, the manufacturing sector, has also been in quite steep structural decline. That paints a pretty weak picture for European macro.
Yeah. And Guy, as Kareem was speaking there, I'm just diving into some of the details. I'm sure you are as well. The line that stood out for me is that despite the data, business confidence across France strengthened and growth expectations were their most optimistic for 4 months. How long does that last? Well,
however long the French government may last, we'll wait and see. Some political stability is probably a factor here. This year seems lost for French factories. That's the line on the manufacturing front. The flash PMI for manufacturing showed slight improvements in September, but remains deep in recession territory. Output is shrinking at the fastest pace since the beginning of the year, and new orders continue to decline. As a result, employment shrank. The situation remains bleak, and industrial companies lack optimism. Yeah. So I see your kind of what companies are saying, and I raise you what is happening in the manufacturing sector, which is less important for the French economy. We'll see what happens with the German data.
I've got a counter with a bright spot because it's verbatim saying a bright spot remains the stable employment levels and easing price pressures. A little optimism for you.
OK, orders from North America and key European markets like Germany are particularly affected. OK, so the data don't look good. So as you look at the PMI data, what is that? Let's come back to this single stock story. How do you pick names within this kind of environment? Which sectors are we looking for in terms of where we're going to get the outperformance coming?
Sure. I mean, that's where we need to come back to the tailwind, speaking of bright spots. Earnings in Europe ended a 10-year period of stagnation earlier this year. So on the whole, European equities have become more investable as the earnings backdrop has become more positive. There are positive stories. And the tailwinds that come from the ECB, what you mentioned, the easing price pressures, that will provide more impetus for the ECB to be able to accelerate rate cuts. So that starts to put into focus rate-sensitive stocks into next year. So
do you think the optimism that Kriti's referencing is optimism based on the idea that we're going to see political stability, or is it based on the idea that we're going to see maybe some ECB rate cuts coming through?
I think it's more the ECB rate cuts front. So I look at sectors, I still keep a quality tilt to European stocks, but I look at sectors within healthcare where there's positive stories, banks, because even if the rate cuts are going to come down, we're not going back to post-GFC rates, we're not going back to zero rate policy, so banks can still generate profits. So these are the areas that I start to look through.
For the time being, it feels like a post-Olympic hangover for France right now, certainly on the service sector. Karim Chedid, Head of Investment Strategies at iShares EMEA BlackRock, thank you very much indeed. Rightmove, rejecting the earlier offer, examining the new offer, understandably, as a result of which its stock is trading around 700 at the moment. We're up by 3.5%. I want to take you back to Liverpool, back to the Labour Party conference, back to Lizzie Burden, standing by with another great guest. Lizzie, over to you.
Well, guys, speaking of hangovers, the warm white wine has been flowing here in Liverpool. It's day 2 of Labour Party conference. It's business day. Labour says it's the biggest business day they've ever had. Let's get the view of what business thinks of Labour now that they're in power. I'm pleased to say that we're joined now by Bruce Carnegie-Brown, who is chairman of Llyods of London. Good to have you with me, Bruce.
Morning.
We've had lots of wealth creators telling us that they're planning to leave the UK because of potential tax hikes in the October 30 budget. Do you think the city's going cold on Chancellor Rachel Reeves?
I think the government has a very fine balancing act to execute over the next few weeks, which is to balance this issue of economic growth, which is at the centre of their economic policy, with the need to restore the balance sheet, which has been badly damaged by the interventions around the pandemic and around the energy price crisis. And so getting that messaging right will be really important over the next few days.
Yeah, of course, it's the messaging, but it's also the timing. If they focus on repairing the finances for too long, those wealth creators and investment might not be there when they need it, right?
So you're exactly right. And it's getting that balance right, giving people hope that we've got a plan for growth in this country, but we're also serious about mending the fiscal balance sheet. And if we don't mend the balance sheet, there won't be any growth either, because people will be nervous about the impacts of that.
So if, for example, the government does equalise the rate of capital gains tax with income tax, what scale of exodus of investment do you expect from the UK?
Well, it's quite hard to predict that, I think. But I think if it was really equalised, that would have quite a severely negative impact on international investment coming into the UK.
Would it be easier than tax hikes if they just changed the fiscal rules to encourage more borrowing to invest in public infrastructure?
Well, I think, again, you've got to be careful to do that, because if the market isn't convinced that you're being appropriately balanced and disciplined with the balance sheet, then you're going to get into trouble.
Well, today we're expecting Rachel Reeves to lay out a positive vision for the UK economy. Do you think she's been too gloomy about the economy over the summer?
Well, it's unsurprising that there would be some kind of a reset when the new government comes in. And I think we've all forgotten just how big the fiscal interventions were around the pandemic and around the energy price crisis. So it's unsurprising that we've got a big balance sheet hole that needs fixing, but getting that message right.
Yeah, that's the public finances, but the economic data haven't been as bad as the Chancellor's been saying.
No, it's actually been quite good. I think that sort of muddle through that we tend to manage so well in this country has worked reasonably positively. So I think the ingredients are there for us to grow at a faster pace, but I think we could equally choke that growth off if we are overly focused on restoring the balance sheet.
So what do you want to hear from the Chancellor in her speech today?
Well, I'd like her to be setting out consistent, predictable plan. So the great joy of this new government is the opportunity to have stability and predictability. We haven't had that for a long period of time. And so to lay out plans that are clear and consistent against which people can invest with confidence, I think will make all the difference.
But is all this Westminster tittle-tattle about infighting at number 10 and freebies actually at odds with that stability you say investors want?
Well, I think as long as they get the fundamentals right, some of the tittle-tattle, as you call it, will disappear. So I'm much more interested in what the content is really for the economy and for investing in the economy.
I mean, of course, it's not just tittle-tattle. It cuts through to the voting. We were speaking to Ipsos earlier. I also know that you're on a panel later. You're talking about Labour's foreign policy agenda. How prepared is the UK under Labour to manage global risks?
Well, it's always a learning experience, I think, when you come into government to understand the complexity of the international geopolitical world. And it's very easy in opposition to make relatively straightforward statements about what's good and what's bad, but the world doesn't fit into one or other of those categories. At Llyods, what we do, of course, is underwrite a lot of geopolitical risk around the world, and it's our job to take those geopolitical risks off the balance sheet of our commercial customers and put them onto our own. And I mean, a great example of that is the Black Sea grain corridor coming out of Ukraine and taking grain to emerging countries, principally in Africa. And we underwrite the ships and their cargoes, and those ships and cargoes wouldn't move without private sector capacity to underwrite the risks. And so in the last 20 months, 30 million tons of grain have passed out of Ukraine through the Black Sea, and over 1,000 ships have been used to transport that grain.
I mean, as you say, you've got this really close-up view of risk. Is Labour being realistic on that risk? Is their approach more realistic than the Conservatives?
Well, I think the new government has been very clear that it wants to have a partnership with the private sector, and I welcome that. It's one of the reasons to be here today. And the private sector will be helpful in providing expertise and advice to government on what risks can be transferred, what can be mitigated, what risks the government itself has to retain. And these will all be complex issues, and there will be difficult choices to make, but that's what being in government's all about.
OK, Bruce Carnegie-Brown, Chairman of Llyods of London, good to have you with me here in Liverpool. And we'll go back to London now. We're awaiting this speech from Rachel Reeves later. What is she going to set out ahead of that budget on October the 30th? Back to you.
All right, Bloomberg's UK correspondent Lizzie Burden speaking at the Labour Party annual conference in Liverpool. Of course, as she was speaking, I should mention some serious weakness in cable, a 132 handle that we are looking on, that currency pair, 111 on euro-dollar, all matched with some weakness in the futures action as well. So a lot going on in these markets. We're going to keep you apprised of all of it. But coming up on the program, a busy 24 hours for Germany as the SPD avoids a shock defeat. The latest PMI figures as well out of the country due shortly. Already seeing some weakness in France. That Paris Olympics effect is wearing off. Do we see further weakness in Germany? We're going to dive into that, dive into the politics, and of course dive into the geopolitics as well. Is there a China read-through we need to pay attention to as well? All of that and more coming up next. Stick with us. This is Bloomberg.
Ouch. The German PMI data drops onto our screens. You don't often see a 40, but we've got a 40 on German manufacturing. So German manufacturing PMI comes through at 40.3. That's down from 42.4. 42.4 is not a great number. Remember, this is a diffusion index. This is a kind of month-to-month story. So things are getting significantly worse, it seems, in German manufacturing. We do, though, stay above 50 when it comes to the services number, but that takes the composite number, Kriti, to 47.2, down from 48.4. But that is an ugly read on manufacturing.
Seeing a lot of pain there and further weakness in euro-dollar. 111 is where we're at. Also matched with further weakness in cable as well. How low does the drop go? It feels like perhaps some of this was anticipated as we saw that weakness in the French data as well.
Absolutely. The French data has dropped back. We're certainly seeing that. I'm just waiting for the PMI data released to come out of Germany. I've got the German one. There we go. Let's read through exactly what they are asking for. We'll go through the Are You Are Human test just to make sure that we can get that done, and then we'll read through to see what is happening. But the expectation is that we are seeing a sort of China read across, and that has been a factor that Germany has been having to deal with for quite some time, and it looks like that narrative is continuing today.
It absolutely is. And I think, look, this is also something to put in the context of some crucial conversations. You mentioned the China piece. When we're talking about this in comparison to some of the problems they're dealing with on the immigration front and the election story, we're going to talk to Oliver Crook about that in just a moment as well. There is no way, it feels, to actually stem some of the losses. And, of course, as we get that data, let's talk a little bit about the market reaction as you dive into the details of that data. You are seeing the spread between that French and German debt continue to widen. We are now at about 79 basis points as well. We were at about 76, 77 prior to the French data. So we're continuing to see that pain in the bond market.
Let's just see if we can get some headlines to come through. A sustained decline in the backlog of work hinted at decreased capacity utilisation across the German private sector. Firms are able to complete orders at a quicker rate rather than they were being received. That doesn't sound particularly good, i.e. the orders aren't coming in that quickly. The downturn in the manufacturing sector has deepened again, evaporating any hope for an early recovery. Output plunged at the fastest rate in a year, with new orders collapsing. That's the narrative coming out of Germany right now. Ollie Crook is going to put some more on this story. Ollie, walk us through what these numbers mean. This is grim data.
Yeah, I mean, listen, Guy, we were already anticipating it to come in at 42.3, which is already a very poor reading on PMI data for manufacturing. It's deep, deep contraction territory. And, Guy, as we've talked about many, many times on this show, I mean, this adds to this streak of losing for German manufacturing. We've been in contraction territory for now we're into our third year, which is really crazy when you think about it. More than 2 years of full manufacturing contraction within Germany, and that print coming out at 40.3. That's the lowest print we've seen on German manufacturing PMI data since last year. So, you know, in the sense that you're hoping for a recovery and a turnaround in the German economy, it's just not something you're seeing on the manufacturing front. And we've talked about the difficulties in manufacturing for a very long time, Guy and Kriti, but what we're seeing now is we're starting to see the sort of rubber hitting the road, sort of almost literally here, when you see kind of releases from Volkswagen and other car makers, the amount of pain. Remember, these companies also had a huge amount of backlogs after the pandemic and a lot of stored-up demand. That backlog has run out, and you're seeing it represent itself in the PMI numbers, and we're seeing it represent itself in statements from the likes of Volkswagen talking about potentially cutting up to 30,000 jobs and closing factories. This is just adding to that narrative and sort of negativity in German manufacturing space right now.
So, Ollie, let's broaden this out to the conversation when it comes to the politics as well. The election results far closer than a lot of people were expecting. Just how much of a victory was this?
Yeah, so listen, Kriti, it's kind of like German growth, right? Where you can get a couple of basis points positive, a couple of basis points negative, and you can get technical recession, this, that, or the other. But at the end of the day, the story is the same, is that this is an economy that's not doing well. And that is sort of true for Olaf Scholz and the government. You might be able to win and sneak out a victory, as they have done. The Social Democrats managed to win in the state of Brandenburg, which is the state around Berlin. But they barely won by less than 2 points, right? With the AfD, the Alternative for Deutschland, the extreme right coming in second. And it's meaningful, Kriti, because it is, yes, another sort of East German state where the sort of populist movements have done very well. But this has been a safe territory for the Social Democrats since the reunification of the country in 1990. For them to win it by only 2 points, less than 2 points, is hardly a sort of rousing victory for Scholz and the SPD, to say nothing of the fact that the other two coalition partners in this region both had so few votes that they're actually booted from the local parliament. They don't even have the 5% threshold to get into that government. What you now also need to pay attention to is next year, when you have the federal election, which is a year and a week away. I think that this sort of will quiet a bit of the discussion about whether SPD, Scholz is the right man to lead it. I think if they had lost here, there would be a lot more discussion about it. But a year is a long time, and that is certainly going to be a present discussion as we lead up to the federal election next year.
Ollie, some lines out of the PMI statement. A technical recession now seems baked in. Optimism is something of the past. How does this kind of economic malaise that we're seeing in Germany, which is getting worse, it seems, judging by the commentary that we're getting from market, how does that fit with the immigration story? Olaf Scholz has been out trying to do deals to get skilled labour into the German economy. That is something that doesn't sort of tally with what we're seeing at the polls. How does the how easy will it be will he be able to deliver a sort of positive immigration story given the bleak economic backdrop?
So listen, I think that these are two things that work against one another. Part of the reason you have a bleak economic backdrop is because you don't have enough workers in the economy. When people are insecure about the economy, there tends to be a slightly more sort of xenophobic and a lot more fear and more strict immigration policies. These two things work against one another. And you've seen that these sort of political parties on the far right and the far left have pushed Olaf Scholz towards a sort of more strict immigration policy. And I think that what's really interesting is I caught up with the Danish Prime Minister on Friday, and this is a social Democrat guy in Kriti, but who also has very strict immigration policy. So I asked her where she thinks the conversation around immigration in Europe is going more broadly. Have a listen.
It is changing a lot, finally. Thank you, dear colleagues. We should have changed the rules and the legislation in Europe a long time ago. It is actually because I am a social democrat that I'm quite tough on migration, and of course especially on irregular migration, because if too many people from outside Europe enters Europe, the problems with lack of integration will simply be too big and too massive. We have to be, unfortunately, quite tough on migration. We have to be in control with our external borders. We have to be able, as leaders, to say if people come to Europe and if they commit serious crimes, then we should be able to tell them to leave Europe again.
Behind this equation is that it is true that on the one hand, in Germany, you have a near record net level number of refugees. You have 4% of the population in Germany is of refugee background. This is something that is obviously politically very challenging. While on the other, you have not had replacement rate of birth within Germany for over 40 years. And so you need to sort of be able to balance these two things. And that is the really unenviable position that Olaf Scholz finds himself in right now. While on the one hand, intense backlash against immigration, while on the other, knowing the economic reality that it is required.
Ollie, great analysis. Thank you very much indeed for joining us. Ollie Krug out of Berlin. So we've got the bad news. A technical recession seems baked in. That's the commentary coming surrounding the PMI data out of Germany. Daniel Zwin, CEO and CIO and co-founder of private credit firm Arena Investors, joining us around the table. He's in Europe. He's then going to Asia. We'll get his take on what is happening around the world. But let's start in Europe. Is bad news like we're seeing in the PMI data this morning out of Europe good news for a company like you?
Well, I would say it's not unexpected. These are chickens that have come home to roost, and they've been roosting for a while, right? We had really profligate monetary policy starting in Europe with Draghi in 2013, and it was compounded by really irresponsible fiscal policy starting with the kind of reaction to COVID. And so when you put all that together, you know, the bill has to come and get paid. And so we've seen, you know, very interesting opportunities, in this case with Germany, France, et cetera. What we're seeing across Northern Europe is the first time it's really been exciting to invest in between 20 and 30 years, right? Because banks were so overly generous with their capital for so many years, which ultimately led to things like what we saw in the GFC, that, you know, they've been forced to kind of step out of the market and given us a lot of opportunities to kind of be financiers to industry and to property at the right levels.
Can you be a bit more specific? Where are those opportunities being thrown up?
Sure. Well, you know, it's really a tale of two sets of countries really throughout Europe. In Northern Europe, in the UK, Scandinavia, Germany, et cetera, we're creating new financiers. So we, as an example, in the UK, we've created a new business factoring receivables for small manufacturers in the UK. We were creating a new business doing asset-based lending. We've just created a new business to do smaller-scale commercial mortgage bridge lending, right? These are all things that were kind of wildly mispriced by the banks, right, who then got themselves into trouble in 2008. And it took a long, long time for those kind of real errors to kind of show themselves through and provide us opportunity. In Southern Europe, however, there's still a bit of a hangover, right? There are still a lot of assets that never really were truly digested, right? Sometimes they're still in the banks, but other times they've been put into funds and kind of put on a shelf for a long while. And so, you know, throughout what used to be called the pigs countries, so to speak, at least the subset of those that are in Southern Europe, we've been buying assets and rationalizing them over time, both primarily more on the property side than the corporate side.
Let's take that piece by piece and
Sure.
start with, you made a lot of comments around the GFC and kind of the role that banks play in the current environment when it comes to private markets. Jamie Dimon very famously compared the private capital markets, specifically the private credit financing structures that are coming about, becoming more and more complicated, to something you saw back with the GFC, comparing it to kind of the mortgages and the structured products there. Why is he wrong or right in making that comparison?
Well, I think what you found in the European banks and what they experienced in the GFC is a lot of times they really didn't understand what they were owning, right? And so they really were stuffed with a lot of things that were very problematic that, you know, some basic arithmetic could have allowed them to avoid. And so what they found was then there was a great overreaction, a great overregulation and misregulation of banking markets. And that's now been compounded with the issues that have arisen in the last couple of years, which is that they realized that demand deposits at banks are no longer kind of steady, right? And so because of technological disruption, not only have they kind of had real errors on the left side of the balance sheet, but now they've realized the right side of the balance sheet is unstable. And so there's not a lot of business to be done for them or by them.
Compare this, though, to, and then you bring this into kind of the way some of these deals are designed. This is, I could get into now financing and all this really, really nerdy talk. But again, the concern comes down to where the opportunities actually lie. And right now, there seems to be a concern that in the absence of some of this bank assistance that was such a commonality, say 10, 15 years ago, instead, it is now a question of size when it comes to the deal, and that you do need to have the bigger players, your Apollos, your KKRs, to actually step in with the bigger capital to get these deals across the finish line. Can you do that if you don't have that much liquidity?
Well, those firms do have access to capital in a way that's very different than the banks, and so they are going to step in. And I would say flying way above the clouds in the ultra-large transactions, there's a real opportunity. However, you know, in the bubble time leading up to late 21, there was a really overly generous provision of capital by non-banks, right? And you saw multiples here in Europe in the middle market private equity space way higher than they should have been, higher than the U.S. You saw credit statistics and credit covenants really being weak, right? And so now you're going to start to see that play out here, where a lot of the things originated by non-banks leading up to the end of the bubble in late 21 are going to start to unwind. And so there's going to be kind of a double opportunity. And a lot of instances, a lot of those businesses are saying, well, there's a great opportunity now, right, because the banks are really gone, but they're not necessarily pointing to, you know, the kind of things that they did before the bubble ended.
Just listening to you, we're still dealing with GFC, which I find amazing.
Yes.
Astounding. And we're now also having to factor in what happened around the pandemic into that story as well. There's going to be, in your mind, an unwind that flows from that.
Yes.
Europe is a master at kicking things down the road.
Yes.
Are we reaching the point where that's no longer possible? Is it better to take your lumps in the near term, or is it better to draw them out and kind of hope for the best? How do you see it playing out? Give me a sort of sense of the timeline.
Well, I think for the citizenry, it's better to take your lumps in the near term. But for monetary authorities and politicians, it's always good to kind of push it off into the future. And so that's what you see happening. And particularly in Europe, where you have this kind of great heterogeneity in kind of rules, systems of recourse, languages, documentation, it makes it all the easier to kind of just push things away. We've bought busted things out of Southern European banks that are kind of deep in the bowels of the banks for a decade, right? Not only because they were trying to bury the issues, but also because it took them a huge amount of time just to get their hands on the assets through a foreclosure process that's incredibly inefficient. And
in terms of the discounts you're looking at, just give us a sense of the kind of valuations you're seeing.
Sure.
And kind of how that is going to evolve. And now there's a little bit of light being shone on these assets, how easy they are to value. How easy is it to get a mark on some of this stuff?
Well, there's getting a mark, and then there's valuing something, right? And so the marks are not necessarily the value. And we're going to see more and more of that show itself over time as people kind of realize the actual values of assets as they try to actually sell them, right? And so what you're seeing is generally in the marketplace this real barbell between busted situations that really don't have much of a bid, where we're underwriting those to kind of 18 to 20+% unlevered returns in credit and yield and assets. Right. And then left side of the barbell opportunities that I've talked about in Northern Europe, where you're at kind of 13 to 15% unlevered, and you actually have access to what they call term non-recourse or steady financing from normal financial institutions in the mid-high single digits that get you to that same 18 to 20 on a levered basis. And so, that's a high cost, right? And part of that is because people are recognizing that there's real risk there between risk-free and where the risk is. And then also risk-free has obviously gone up 10x.
Yeah.
And so you have kind of a double whammy hitting those folks that own those assets that need to actually get rid of them.
Part of this drive in private markets in Europe as well is a function of the fact that governments can't actually invest right now. They are quite literally handcuffed fiscally. Walk us through just how long this kind of influx into a lot of the infrastructure deals, some of the juicy opportunities you're talking about, specifically in the periphery, will last. What gets in the way of that?
What gets in the way of the opportunities arising?
What gets in the way of what feels like untenable appetite for Europe at the moment?
Well, I think ultimately there's going to be a spreading out of this rationalization of assets and opportunity. And so you saw it start in the kind of tech and growth area. You saw it kind of move to funds. It then moved to CRE, and it's coming in a real way to leverage finance and corporate. And so I would see this as a multi-year opportunity on both sides of the barbell to really kind of engage with the marketplace. And furthermore, there's a lot less development in Europe than there is in the U.S. So, for instance, in Europe, you talk about all this immigration and think about the fiscal issues that are out there. Europe has an enormous growing subprime consumer base, right? But there's no subprime consumer finance.
Yep.
It barely exists here, right? And so that is a need that's going to need to be met by somebody, right? As an example, and so there's going to be a lot of development in kind of new markets and new products to kind of service a new European citizenry that hasn't existed before.
All right, we'll leave the conversation there. Daniel Zorn, CEO, CIO, and co-founder of Arena Investors, we thank you so much. Coming up, we're going right back to Liverpool with a conversation with Labour donor and Ecotricity founder Dale Vince. That conversation next. This is Bloomberg. Welcome back to the opening trade. Let's head back to Liverpool and the Labour Party conference. Bloomberg's UK correspondent Lizzie Burden on location. Lizzie, over to you.
Well, Kriti, we've heard from the government, we've heard from the city. The other crucial part of Labour's growth mission is, of course, green jobs. So let's speak now to Dale Vince, who's founder of Ecotricity, the clean energy company, and he joins me here. Dale, good morning.
Morning.
The Chancellor slashed the Energy Secretary's annual investment pot from £28 billion to £4.7 billion. Are you convinced of the government's commitment to net zero?
Yeah, I am, and that happened a while ago, right? Yeah, I thought it did. Yeah, look, I understood why it was done at the time, and there was uncertainty about how much money there was in the bank, basically, and there's more certainty now, and there's a big black hole. I don't think there's a lack of commitment, but also I don't think that we need a lot of money to spend to get to 100% green on the grid, because renewable energy onshore doesn't need price support. So onshore wind, onshore solar actually needs no money at all.
Well, you mentioned that £22 billion hole in the public finances. More broadly, is the Chancellor squandering the government's potential to change Britain for good by being too wedded to her fiscal rules? What would you want to hear from her speech today?
Well, you know, I'd like to hear a little bit of boldness. I think we will hear some. I'm not overly familiar with the extent to which the fiscal rules are constraining plans for growth and stuff like that. But I would say that rules can always be changed. And if the fiscal rules are a problem, then I'd like to see them changed, particularly in the context of borrowing to invest, because all businesses know if you can borrow to invest, that's how you grow.
OK, well, you're not the only one. Leading economists have asked us to do that as well. And you're really a wealth creator. We've heard from lots of wealth creators who say they're planning to leave Britain because of her potential tax hikes in the budget. Are you planning your exodus?
I can't believe people say that, right? This is a great country to live in, and if somebody would rather leave here than pay their fair share, I say they should go.
And you're also a Labour donor. We've had lots of questions being asked about the access and influence of Wahid Ali in exchange for his donations to the party. Does it all smell right to you?
That's not a very nice turn of phrase, but I don't think there are any problems. I mean, I've known Labour for quite a while, been giving money to them for quite a while. There's never anything asked for or offered. It's a very straightforward business. I give them money to help them win the election, and that's the end of it.
Well, now they're in government, how do you want your money spent?
Well, I think it's been spent to win the election.
And you've also been vocally pro-Palestine. The Foreign Secretary's already instituted this partial arms embargo on Israel. Has he gone far enough for you?
Well, I'm not in the detail of which weapons, are offensive and which are defensive. But I think that we should be bolder with Israel generally because of what's happening. Over 40,000 deaths, mostly civilians, and 100,000 injuries, and millions of Palestinians suffering, virtual starvation and almost plague, and that kind of stuff. I think, these are breaches of international law as well as just, good simple behavior. And we haven't tolerated a fraction of this in Ukraine with Russia invading Ukraine. But we've tolerated this situation in Palestine for decades, and there's no solution other than a two-state solution, and we should get to grips with that as an international community and make Israel hear us.
I mean, as a donor, is there a red line for you in terms of when you would stop donating to Labour because of their foreign policy on the Middle East?
No, I don't think like that. I've not got red lines and stuff like that. I just urge publicly for what it is that I think should happen.
All right. Dale Vince, good to talk to you here at Labour Party conference, a crucial voice and a Labour donor as well. Dale Vince, the founder of Ecotricity. We'll go back to you in London now.
All right, Bloomberg's UK correspondent Lizzie Burden over at the Labour Party annual conference in Liverpool, bringing us some great guests throughout the morning program. Guy, it feels like the focus is really much on the currency market, on the bond market. Yep. 132 handle on cable, 111 on Eurodollar, and I'm told by our very own Anna Edwards as well, we've got an eye on Spanish debt, perhaps getting very close to erasing its yield premium over French debt. That's saying a lot about the political landscape that we're in.
The data out of France isn't particularly pretty this morning, aren't particularly pretty. The fact that services has come down as fast as it is, I hear the commentary that the outlook is a little bit more positive, i.e. the expectation for the French economy to improve is better, but these are still not great pieces of data that we're seeing in terms of the PMI. The chief economist at Hamburg Commercial Bank commenting on the German PMI data, really grim. The downturn in manufacturing sector has deepened again, evaporating any hope for an early recovery. A technical recession seems, quote, to be baked in. These are not good pieces of data out of France and Germany right now, and they speak to the sort of political trouble ahead. It's hard to get on the political front foot when the economy is not delivering, and that, I think, is referenced by what Barnier is talking about. Scholz is really struggling right now. It seems as if any imminent recovery in either economy looks to be evaporating fairly quickly.
And they've got to get this budget under control. We've got the deadline over for the French budget submission to the EU. Already get that extension requested. Now setting the precedent for other economies in Europe as well, pushing that deadline further and further back. It looks like the EU can't do their job in terms of regulating, in terms of getting their kind of ducks in a row until really the end of the year. That is quite the delay in terms of actually executing and bringing a lot of these finances into order.
Yeah, are they going to get the finances in order? I think that's a key question. Is there any kind of sort of post-Draghi idea that we could see some sort of common borrowing, that we could see some sort of common approach here? Looking at what we're seeing on the screens in front of us, that looks like it's really difficult. We're going to be speaking to the Japanese Prime Minister a little bit later on today. That is an interview you do not want to miss. This is Bloomberg.